So, all right, Chapter 12, Intangibles. Intangibles have no physical substance, but they do have a great deal of value. It is one area that includes, we'll see, a lot of patents and trademarks and copyrights and franchise and licensing from various municipalities that have value. You know, like an FCC license in order to broadcast your radio station or TV station, that has a great deal of value to have that. And so the cost associated with obtaining that right is capitalized and put into the intangible assets section. All right? So the only thing that can be capitalized are either one, externally acquired. So you buy another business. There's a couple of intangibles that can be, well, there's a number of intangibles. Things like a customer list. If that's the reason you're buying this business is to gain access to their customers, then you can attach a value to that, capitalize it, and then amortize it over its useful life. If you're acquiring this business because they have some research in process, you can capitalize that. If you're paying more for that business than the fair market value of the total assets, less any fair market value of liabilities that you're acquiring during the acquisition, that's called goodwill. That can be capitalized. If you go out and you buy a patent, or you go out and buy a trademark or a copyright, then you can capitalize that. Internally developed are not. They're expensed as they incurred. So, got a little error message up there. So everything that you do in research and development, and we'll talk about that in a few future slides here, is expensed as you incur it. And that's not the way the rest of the world treats it. And I'll talk about the difference between that. So here's a variety of identifiable. Trademarks and trade names, certainly patents, copyrights, franchise rights, customer lists and relationships. All of these are capitalized by either external purchase or by, you can certainly capitalize the legal fees associated with filing for a copyright, a trademark, or a patent. So you can capitalize that, as well as the cost of successfully defending any of those. Successfully being the key word there. Because what if you're not successful in defending your copyright? Then any cost you have capitalized in that particular asset is useless anyway because you didn't defend it, right? If you don't have access to the copyright, you lose the court case, then you have to write off everything associated with that copyright or trademark or patent, right? Okay, like I said, they're purchased from an acquisition or either separately purchased as individual assets. Internally are generally, and I'll say generally because there are some exceptions associated with filing costs and such like that, are expensed as incurred. So here's internally developed. Research and development, of course, is the big one. And I'll mention it here and we'll talk about the expensing of research. This is a major difference between U.S. GAAP and the International Financial Reporting Standards, IFRS. IFRS, you're allowed to capitalize development. You still have to expense research, but once the product becomes technologically feasible, then you're allowed to capture all the future expenditures into a development asset and then amortize that either on a per unit basis or over the life of the particular product that you're developing. A good example, Airbus is headquartered in Toulouse, France. Boeing is headquartered in Chicago, California now. Chicago, Illinois. Chicago, California. Anyway, my brain's frozen. It's too cold for me to operate. The two build airliners. Well, once an airliner becomes technologically feasible under the international, so it gets into flight testing phase, test flight. All right, so by the time they build one and roll it out of the hangar and start flying it, it's technologically feasible. At that point, Airbus no longer has to expense all of the cost of developing an airliner anymore. They get to put it on the balance sheet. So that's a major difference between Boeing's income statement and Airbus's income statement. All right, so that. Identifiable, and then there are two that are capitalized. Either they have a finite life or an infinite life. And I'll talk about that here in a second. Amortization on anything with a finite life. So patents in the United States are generally have a legal life of 20 years. When you file for a patent, you get to use that technology or business process or whatever it is that you're filing the patent for 20 years. However, you may not use that patent for 20 years. You may only have a management's intent of using that patent for 5 years. I mean, Intel builds a new processing chip about every year. All right? They stop using the old processing chip way before 20 years goes by. They will no longer manufacture it. So it doesn't make any sense to take whatever cost they had in patenting that they have successfully capitalized, or even defending it, and amortize it over the 20-year legal life. Because always remember, we've got an underlying assumption. We're trying to match revenues with expenses. So if you're no longer producing this particular version of that processing chip, then why would you continue to amortize it? All right? It's a subtle difference, but it's important. So if they give you a useful life of 3 years and a legal life of 20 years, amortize it over the 3-year period, because that's when you're going to use it. All right? Impairment, and we talked about this a little bit in chapter 10 when we talked about fixed assets, and I've not really seen much of a impairment with fixed asset, but the same calculation holds for impairment of intangibles, and it's much more common. So if you've got an intangible asset with an infinite life, trademarks, copyrights, goodwill, it has an unlimited life. You have to make this calculation on an annual basis for impairment. And the impairment process, I've got a couple of slides on. It's not complicated, but you need to go through that annually. Your auditor is going to insist. All right? So, we talked about that. So, estimated future life is how long do you expect to use it? So, another good example is that you buy a copyright from an author in order to publish his or her novel, right? If you only intend, by management's expectation, to sell this thing for the next 3 years, at which point in time the sales will drop off precipitously. You may get the occasional edition bought somewhere down the road, but the bulk of the sales are going to incur in the next 3 years. Then you need to amortize the cost of that copyright over that 3-year period. Or more than likely, if you expect the book to sell 1 million copies, let's say, then you amortize it on a per unit basis over the 1 million copies that you expect. Okay? So useful life is always the one that you're going to fall back on. All right? So here's a patent. You expect to $85,000. You bought it externally, You're going to use it over the estimated economic life of 10 years. So even though if it was a brand new patent, you've got the legal rights for 20, you're going to take $8,500 per year over the life of the 10-year economic life. So very straightforward. Here also is a subtle difference with property, plant, and equipment. With intangibles, it is common to reduce the actual cost of the intangible asset. So the credit doesn't go to a contra asset account, accumulated amortization on patent. It goes straight to the patent. Very common to do that, and allowed. Not allowed with tangibles. You always have to display the original historic cost on a tangible property, plant, and equipment, and then take the contra asset account of accumulated amortization. So in this case, you can take it straight to the patent. All right. Impairment has a two-tiered test, and it's not as complicated as it sounds. You first, and this is the exact same style test that we briefly went over with tangible. You take the undiscounted expected cash flows. So if you've got a patent that is going to generate revenues over the next 3 years, or a copyright that's going to generate $1 million worth of, or 1 million issues worth of sales on a novel, you take that undiscounted cash flows, compare that to the book value of the intangible. All right? Then, if the book value is less than the total expected future cash flows, you then take a loss compared to the difference between the book value and the fair value. And the fair value can traditionally be calculated by discounting those cash flows back to the current period. And that's the loss. And so here's an example. You've got a patent with a book value of $68,000. Future cash flows are going to be $40,000. So it fails the first test. All right? Because it fails the first test, you then have to go to the second test to determine the level of the write-off. And so the present value of the future cash flows is $25,000. So there were $40,000 undiscounted, $25,000 discounted. You're going to take a loss of $43,000. That's the difference between the current book value of $68,000 and the the discounted present value of $25,000. And that's it. But this is a calculation that you're going to be doing frequently. And when you're dealing with goodwill on a subsidiary, and you'll be seeing this when you get to advanced financial reporting in graduate school, that 6340 class, it's dealing with consolidation, because this same basic calculation is done on a complete subsidiary level in order to determine whether or not there's an impairment of goodwill. And you have to do that for each and every subsidiary that you have booked goodwill on the acquisition. Okay? All right, does this make sense? Okay. So indefinite lived assets reviewed for impairment. So purchase a trademark for $60,000. They consider it has an indefinite life with a carrying value of $60,000. If you determine at a subsequent date the trademark is only worth $20,000, you know, a good example is what did they used to call it? Florida Air. Florida Air is now, well, transformed into AirTran, and AirTran is just being purchased by Southwest Airlines now. But Florida Air was a trademark. You know, they had rights to all the logos and the name and all this other stuff. And they had a couple of unfortunate incidents back in the 80s, and that trademark became worthless, whatever they paid for it. So they transformed it into another airline. So loss on impairment, write the trademark down by $40,000 to its fair value. So And this is a component for continuing operations. It goes in that same on the multi-step income statement. Impairment, loss on impairments go in there with gains and losses on sale of tangible property. Goes in there with the interest expense and the interest income, that whole section there of other items, other revenues and expenses to come up with the calculation of income from continuing operations. Okay. Research, I talked about, that's the search for new knowledge, whereas development is taking new knowledge and developing new actual products and processes. All right? So a good example is that you decided you're going to build a new airliner, and you're going to make it out of plastic and snap it together like a logo, like a Lego set, and okay, great, but never been done before. But the minute you get one in the air, it's development. Up to that point, it's research. You know, can it be done? Yes, it can. It's called the Boeing 787, flying all over the world now. So, great airplane. All right, so here's just an example, testing and search. These are all considered research and development. Discovery of new knowledge, evaluation of products, alternatives, modifying an existing product or process. So all of the prototypes, the wind tunnel models and all that stuff is all research and development. What is not is troubleshooting a breakdown in an existing product. That's just maintenance. Okay? It's not considered research and development. So routine design of tools, jigs, molds, and dies. So here's a list. Material used from inventory, wages and salary associated with the R&D folks, an allocation of general administrative costs, because you allocate G&A to most of your various profit and expense centers, depreciation of building, housing the R&D activities, and then here's a machine that is purchased for R&D. And here's a subtle difference, and on Thursday, when we get into doing some problems, we'll have a couple of examples of this. If this machine has a specified limited use only for research and development, then you expense it as you buy it. Expense the entire machine, no matter what the useful life is. If, however, it's going to have an alternative use after you get done with the R&D phase and actually take this product into production, you're going to move the machine into the production floor at that point, then you capitalize it as a machine, and then you expense the depreciation during the R&D phase to research and development, and then it would be depreciation in operations once it goes out of R&D. So that's a subtle but significant difference. So if the machine has no alternative future use, you're going to expense 100%. You're going to take out the inventory. You're going to take all of the various expenses, including the $30,000 for the machine, and take that to, that you paid cash for, and then the depreciation to accumulated depreciation. All of that is expensed. $215,000. If it has an alternative use, then you're not going to expense the machine separately. You're only going to take the $6,000 associated with the 5-year life on the machine to research and development. Okay? Subtle difference. Does it have an alternative use in the future? All right, here's this odd little in-process R&D. If you go out and you buy another company as one of your subsidiaries, and the reason or one of the many reasons that you're buying it is to gain access to some research that they're getting ready to be able to take into a productive mode, then you can capitalize the amount that they have expended towards that research as in-process R&D. So this is only during acquisition. and this is quite common because there's a lot of times that larger companies will go out and buy smaller companies because they've hit on some sort of new process, new product, something. So you go out and you buy them, and then you can capitalize that and then amortize it over the life of the actual asset. Okay? If, however, after you bought them, you then abandon the product, then you have to expense the whole thing. Just like an impairment loss, you expense it once it determines that it's not technologically feasible. Okay? Here's a change, and I'll just mention it. Right now, startup costs are expensed. So if you're starting up a new business or you're starting up a new subsidiary, it used to be, back when I was sitting in your chair and some other professor was standing up here at Virginia Tech, and there was snow on the ground, no doubt. You used to be able to capitalize startup cost. That changed in the ensuing 30 years. Now it's all expensed. Okay? So everything associated with introducing a new operation, a new product, going into a new region, no matter what, you expense it all. So any legal fees, stock certificates, underwriting that you have to do associated with forming a new company, no longer capitalizable. Okay, you used to capitalize it and then amortize it over, I believe, either a 10 or 20-year period. I can't remember a straight line. That was a long time ago. I'd have to go look in my intermediate book. It's not important. So, 5 basic categories of intangible assets are marketing, intangibles associated with customers, artistic works, contracts, and technology. So marketing is primarily trademarks and trade names. So the UIW, the steeple, the cardinal head, the right-facing cardinal head with the red beak. That's the only trademark that we have. If it's a left-facing cardinal, it doesn't belong to us. And if it's got a yellow beak, it doesn't belong to us. It's got to have a red beak. Apparently, there is a cardinal out there with a red beak. I've seen pictures of it. Who knew? All right, so those are trademarks and trade names. These do have limited lives. Trademarks have a 10-year, but they're renewable indefinitely. So trademarks are considered an indefinite life, but you have to renew them every 10 years. So how would you like to be the guy in the legal department at Nike that forgot to redo the Nike swoosh? Whoops, so sorry, it expired. No, that would be awful. So all of that can be renewed indefinitely. And then as you pay legal fees associated, external, if you've got your internal legal department working on the filings, you can't capitalize that. But if you paid an outside lawyer to redo this, then you can take that to your balance sheet, those fees associated. Plus any fees associated, as I said, of successfully defending these. All right? Internet domain names, same thing. You can capitalize any external cost. You know, you're paying Network Solutions or GoDaddy to register an internet name. Internet names, there used to be a little cottage industry out there where internet savvy individuals would go out and swoop up URLs for companies before they got there and then hold them hostage and sell it to them. As it was a nice little business back in the 80s, but they shut that all down. There was a court case that eventually said, no. If you go out and you copyright Coca-Cola, Coca-Cola has a right under their trade name protection to that URL. So you can't take it because you're not Coca-Cola. So that's all gone. So anybody goes out there, because it used to be that people would panic every time one of the new little dot something, you know, was in, and now they've got dot everything. I mean, they got dot .us, dot marketing, dot everything. It used to be just .com, .edu, .gov. I think there were 4 of them, huh? .net. .org, yeah, there was 5 of them initially. But now there's a dot everything. There's all sorts of stuff out there. So you don't have to go out there as an entity and buy up every variant of your name because you have the rights to it if you got your name trademarked. So, trade name, okay. Customer-related intangibles, these are primarily only externally purchased. They have a finite life. They're amortized on a straight line basis over the use. So you go out and you buy somebody's business or a product line in order to gain access to a customer list. You can capitalize that during the acquisition, attach a fair value to it, and then amortize that over however many years you think that customer list will be valid. Artistic is primarily copyrights. Copyrights for the written word, and it was asked yesterday, which I thought, and I still haven't looked it up. For the written word, you have a copyright for the author's life plus 70 years. Okay? So Edgar Allan Poe's work is free now. You can download The Raven and The Telltale Heart and all that other stuff because he died in the 1800s. Hemingway, you can't. He died in the early 60s. So you can't download his stuff because it's still under copyright. All right? You can get Plato for free. Shakespeare is free. You have a question?
No, I'm trying.
Oh, okay. Hence the think. So all of that is just 70 years after the author's life. And the interesting question was, does George Lucas get the rights, or his heirs get the rights to the Star Wars franchise that he owns for only 70 years after his death? And I don't know. I don't know about other types of artistic works. Same with music. I can't answer that. But I got to imagine it's something similar. So, because you have copyrights on it. But I don't know. 70 years is a long time ago. All right. So contract-based is primarily franchising. Licensing, so if you get a license to do something from either a federal, state, or local government, they have licensed you to provide bus service in San Antonio, or you get a license from the state of Texas to do a light rail between San Antonio and Austin. Those types of things are going to have a limited life. And you would amortize the cost of acquiring those licensing over the life. Broadcast rights is another big one. All right. And then technology-based is primarily patents. So this is 20 years from the date of filings. I had a student one time that say the pharmaceutical business had less than 20 years. I've never been able to verify that, but I do know that generic drugs.
That's 7.
Is it 7? Is that what it is? So generic drugs come out after 7 years for something different other than the right for this. So it cannot be renewed. So in this, once again, you're not going to amortize the cost of acquiring either externally a patent or the cost of filing an internally developed patent over the full 20 years if you don't have any intent on actually using it to generate revenue over that period of time. So it's whatever useful life that you're going to have. And then software has a very odd little deal. And if you go to work for a software company, I'm sure you're going to get very, very well versed in this one. It is generally research and development, thus expense. There's a graph here. You expense it up until the software becomes technologically feasible. Now, where that definition lies, I can't begin to tell you. But once the software, in other words, I'm assuming you get it out of code and you've given it some basic testing and you removed a bug or two and you decide, okay, this is going to actually work. At that point, you can capitalize any cost associated with getting it to the release date. Because I know a lot of software gets sent out to, pilot. People do beta testing on it, and I mean even the Windows and the Microsoft, the Apple iOS systems. They send them out to these group of user groups to let them play with it and say, does it work or doesn't it not work? So all of that can be capitalized, and then you expense that over the life. Once again, the useful life, either on a per unit basis or a straight line. So that's an odd little section. And if you look in the codification under intangible assets, there's a whole little section in the codification of U.S. GAAP. There's a whole little section on software. So they sure have got lots of definitions and examples and stuff like that. So here's a computer video game. The technologically feasible ended at the end of June, and then they released it on January 1 the following year. So they developed a 1.6 million up until that June technologically feasibility threshold, and then after July to the end of the year, July 1, they spent another 1.2 million. So you're going to amortize that by the 1.2 million over the profit was generated. They expect to have 16 million in total. They've generated 4 million in profit for that first year. So 2012, 300,000. So, okay. Straight line, you would just take it over the 3 years that you expect to sell that particular software. So those are the two amounts. All right. Goodwill, as I talked about, all right? So when you're acquiring a subsidiary, you're going out, you've decided, you've targeted another company for acquisition. You go through and you get a fair value of every asset they have. What is the current fair value of their accounts receivable, their inventory, their property, plant, and equipment, all their intangibles, everything they have on the asset side of the balance sheet. Subtract from that any liabilities that you're going to assume, and it's very common if you're making an acquisition to acquire at least the working capital liabilities, the current liabilities. So because, I mean, employees are still going to accrue payroll, you're still going to have deliveries of inventory, you're still going to generate utility bills, so there are some working capital style accounts payable. Taxes are going to continue to accrue and stuff like that up until the acquisition date. So you make an estimate there. If you're purchasing, the negotiated purchase price is higher than the net of that fair value of all assets minus liabilities assumed, that's goodwill. All right? You're not making just an asset purchase, in other words. You're buying the good name of that company. And that is capitalized and then annually looked at for impairment. So here's a quick example. All right, you've got a book value. A Sarah company is acquiring Trevor. They've decided to purchase the net assets for $790,000. So here's everything. The cash and the accounts receivable are equal to the book value. Inventory is up by $60,000. Property, plant, and equipment is up by another $55,000. So you're at $115. And then they have a trademark that is currently doesn't have a book value, but it has a fair value. So there's something, some style of trademark that this Trevor company owns that is valuable out in the marketplace. So you've gone out and made a arm's length fair appraisal of what the value is. And then you're going to acquire a little over $500,000 worth of payables. So the calculation is that you take all of these, you get a step up in basis. So the acquisition of the inventory is at its fair market value, as is the property, plant, and equipment, and the trademark. Everything above all of that, less the liability, is goodwill. And that $400,000 goodwill sits on your books forever until such time that it has an impairment. And there's a calculation associated with that you will touch on when you get into that graduate course. I just want you to mention it now. Okay? I won't test you on it, I promise. Okay. Bargain purchases, I'm not going to talk about that. All right. That's it. Questions?